The same bubble, wearing a new costume. Every generation believes its bubble is different. Every generation is wrong. In 1637, a single tulip bulb in Amsterdam sold for more than the price of a house. In 2021, a picture of a cartoon rock sold for over $1 million. Separate these two events by nearly 400 years, swap out the flowers for pixels, and you'll find something disturbing. It's the same trade, made by the same kind of person, for the same psychological reason. Markets don't actually learn. People convince themselves they will. Get out in time! And history keeps proving, century after century, that almost none of them do. We call these moments bubbles. But that word is too soft. A bubble doesn't just pop, it transfers wealth. Every single time. From the people who arrived late, to the people who arrived early. And if you look closely at how these transfers happen, you start to notice they follow a blueprint so consistent it might as well be a formula. Welcome to the Financial Historian, where money, power, and history collide, and nothing is ever as simple as it looks. The first bubble nobody believes actually happened. Let's start at the beginning, because the beginning is stranger than fiction. In the Dutch Republic in the 1630s, tulips arrived from the Ottoman Empire and became a symbol of status among the newly wealthy merchant class. Amsterdam at the time was arguably the richest city on earth, flush with capital from global trade, and its citizens were looking for somewhere to put their money. Tulip bulbs, especially rare striped varieties infected with a mosaic virus that nobody understood at the time, became the target. At first, this made a strange kind of sense. Rare bulbs were genuinely rare. Supply was limited, demand was rising, and prices climbed in a way that looked, for a while, like ordinary economics. But then something shifted. People stopped buying tulips because they wanted flowers. They started buying tulip futures, contracts promising a bulb that hadn't even bloomed yet, purely because they believed someone else would pay more for that contract next week. Taverns became trading floors. Craftsmen mortgaged their tools. A single bulb of the Semper Augustus variety reportedly traded for the equivalent of a skilled worker's income across several years. Then, in February of 1637, at a routine bulb auction in Haarlem, buyers simply didn't show up. No crash, no crisis, no war. Just silence where demand used to be. Prices that had climbed in a straight line for months collapsed just as fast, and the people left holding contracts were left holding nothing but a flower bulb and a debt. Here's the detail that matters most, the one that gets repeated in every bubble that follows. The people who made fortunes in tulip mania were not the ones who believed the hype the longest. They were the ones who sold to the believers and walked away early. The last buyers funded the profits of the first. The bubble that broke an empire's trust in itself. Move forward about 80 years, and you land in London, in a story that should be far more famous than it is, because it doesn't just involve ordinary citizens. It involves the government itself acting as the hype man. In 1711, the British government created the South Sea Company and handed it a monopoly on trade with South America, in exchange for the company agreeing to absorb a portion of the national debt. The company barely traded anything of value. Its actual business was almost irrelevant. What mattered was the story. Fantastic riches from the New World, backed by the credibility of the crown itself. Shares soared. Politicians, aristocrats, and even Sir Isaac Newton, one of the greatest minds in human history, bought in. Newton reportedly sold early, made a tidy profit, watched the price keep climbing, panicked that he was missing out, and bought back in near the very top. He later lost the equivalent of millions of dollars in today's money, and is said to have remarked that he could calculate the motion of the heavens, but not the madness of men. That line should be printed on the wall of every trading floor on earth. The South Sea Company's stock rose roughly tenfold in a single year, fueled not by profits, but by rumor, government endorsement, and a wave of copycat schemes so absurd that one company reportedly raised capital for carrying on an undertaking of great advantage, but nobody to know what it is. People invested anyway. When the South Sea bubble finally burst in 1720, it didn't just wipe out individual fortunes. It nearly destabilized the British government, which had tied its own credibility to the company's success. Notice the pattern building already. It's never just reckless individuals. It's institutions, banks, governments, trusted names, lending their credibility to the mania, which is exactly what makes ordinary people feel safe enough to jump in. The bubble that took down a superpower. Fast forward 2 centuries to the United States in the 1920s, and the same psychology returns wearing a sharper suit. After World War I, America entered a period of extraordinary optimism. New technologies, automobiles, radio, electricity, were transforming daily life at a pace nobody had seen before. The stock market became something new, not just a tool for financing companies, but a form of mass entertainment, a national hobby. And crucially, for the first time, ordinary people could participate using something called margin, borrowing money from their broker to buy stock, often putting down as little as 10% of the actual price. This is the part people forget. The 1929 crash wasn't really about stocks becoming worthless. It was about leverage. When you can control $100 of stock with $10 of your own money, a small drop in price doesn't just hurt, it wipes you out completely and forces you to sell, which pushes prices down further, which forces the next person to sell in a chain reaction that has almost nothing to do with the actual value of the companies involved. On October 29, 1929, a day now remembered as Black Tuesday, the market lost about 12% of its value in a single session. Fortunes evaporated in hours. But the crash itself wasn't even the real disaster. What followed was a wave of bank failures, because banks had also gambled depositors' money in the same speculative frenzy, which meant the collapse of a stock market bubble turned into the collapse of the entire banking system, which turned into the Great Depression, a decade of mass unemployment that reshaped the politics of the entire world. The lesson buried inside 1929 isn't just markets can fall. It's that borrowed money turns a correction into a catastrophe, and that a financial bubble rarely stays contained to the people who chose to gamble. It leaks into the banking system, and from the banking system, into everyone. The bubble built entirely out of belief. Now jump to the late 1990s, and you'll find a bubble with almost no physical form at all, just belief, projected onto a brand new technology nobody fully understood, the internet. Investors in the dot-com era faced a genuine, once-in-a-generation shift. The internet really was going to change everything, and in hindsight, it did. But in the short term, the market couldn't tell the difference between a company that would eventually dominate global commerce and a company that was, quite literally, just a website with a catchy name and no plan to ever turn a profit. Companies went public with names ending in .com and watched their valuations multiply overnight, often with no revenue, no product, and business plans that amounted to little more than get big fast and figure out profit later. Pets.com became a symbol of the era, a company that spent lavishly on a Super Bowl advertisement featuring a sock puppet mascot, burned through investor cash at an extraordinary rate, and collapsed within about 2 years of going public. Between March 2000 and October 2002, the technology-heavy Nasdaq index lost roughly 78% of its value. Trillions of dollars in paper wealth simply vanished. And yet, here's the twist that makes this bubble so instructive. The underlying technology wasn't fake at all. Amazon survived. Google was founded during the crash and thrived afterward. The bubble wasn't wrong about the internet. It was wrong about the timeline, and it was wrong about who would actually capture the value. This is a crucial distinction that most people miss. A bubble can be built around a real, transformative idea and still be a bubble. Being right about the future doesn't protect you from being early, over-leveraged, or invested in the wrong company at the wrong price. The bubble hidden inside a house. By 2008, the world had supposedly learned every lesson finance had to teach. And then it built a bubble so large it nearly took down the entire global financial system, hidden inside the most trusted asset most families ever own, their home. For years leading up to the crisis, banks issued mortgages to buyers who, under any previous standard, would never have qualified, loans requiring no proof of income, no down payment, and interest rates that would reset dramatically higher after an initial low period. This alone might have caused a contained problem. What turned it into a global catastrophe was what happened next. Banks bundled thousands of these mortgages together into complex securities, got them stamped with top-tier credit ratings, and sold them to investors, pension funds, and other banks all over the world who believed they were buying something safe. Nobody fully understood what was actually inside these packages. That was, in a sense, the entire point. Complexity became a kind of camouflage, hiding risk so thoroughly that even the institutions selling these products often didn't grasp what they contained. When home prices, which everyone had assumed could only rise, finally turned downward, the mortgages inside these securities began failing in huge numbers, and the securities that were supposedly safe turned out to be worthless almost overnight. Lehman Brothers, a 158-year-old investment bank, collapsed in September 2008 in the largest bankruptcy in American history. Credit markets froze worldwide. Millions of families lost their homes. And in the aftermath, the very institutions whose gambling caused the collapse received massive government bailouts, while the ordinary families who'd been sold bad loans were largely left to absorb the damage on their own. The 2008 crisis added a new ingredient to the old formula: complexity as a weapon. Tulip mania and the South Sea bubble were at least understandable to the people trading in them. By 2008, the products themselves had become so complicated that almost nobody, buyer, seller, or regulator, could actually see the risk they were holding. The bubble you might be living through right now. Which brings us, uncomfortably, to the present. In 2021, a wave of speculative assets, meme stocks bid up by coordinated retail traders, cryptocurrencies with no underlying cash flow, digital collectibles selling for the price of houses, rose at a pace that, when you overlay the charts, looks almost identical to the tulip mania price curve from 1637. Different assets, same shape. Some of these technologies may well matter enormously in the long run, the same way the internet did. That's not really the point, and it never has been. The point is the pattern. An asset detaches from any measurable fundamental value. A story spreads faster than skepticism can catch up to it. New buyers arrive not because they understand the asset, but because they've watched others get rich, and the entire structure depends entirely on someone new showing up tomorrow willing to pay more than today's price. Every bubble in this video followed that exact structure. Tulips. South Sea stock. 1920s margin accounts. .com valuations. Mortgage-backed securities. The costume changes. The mechanism does not. Why this keeps happening, every single time. So why doesn't anyone learn? Why does the same trap catch new victims every generation, even when the previous collapse is thoroughly documented, taught in schools, and turned into movies? Because bubbles aren't really a failure of information. They're a failure of psychology, and psychology doesn't update the way facts do. Humans are wired to trust rising prices as evidence of truth. If something is going up, our instinct tells us other people must know something we don't, and rather than investigate, most people simply join in, because the social and financial cost of missing out feels far more immediate than the abstract risk of a future collapse. Economists have a name for this: the greater fool theory. You don't need to believe an asset is actually worth the price you're paying. You only need to believe a greater fool will pay more for it tomorrow. And bubbles are self-reinforcing in a way that punishes skepticism in real time. The person who says, "This is overvalued," in year 1 looks foolish in year 2 when prices have doubled, and looks foolish again in year 3 when prices have doubled again. Being early and being wrong look identical for a very long time, right up until the moment they suddenly don't. There's also a quieter mechanism at work, one that connects every case study in this video: credibility laundering. Tulip mania spread through respected merchants. The South Sea bubble was endorsed by the British government itself. The 1920s crash was fueled by banks lending ordinary citizens the rope to hang themselves with. The 2008 crisis was built on securities stamped safe by trusted ratings agencies. In every case, the bubble didn't just rely on greed, it relied on trusted institutions vouching for the story, which gave ordinary people permission to stop asking questions. That's the actual danger. Not that people are foolish, but that bubbles are specifically built to look reasonable, right up until the moment they aren't. The pattern even the winners can't escape. There's one more wrinkle worth sitting with, because it complicates the tidy story of smart money wins, dumb money loses. Even the people who correctly call the bubble in advance often couldn't profit cleanly from being right. Betting against a bubble means betting on a specific timeline, not just a specific outcome, and markets can stay detached from reality far longer than any single trader can stay solvent. In the years before 2008, a small handful of investors identified the coming mortgage collapse well ahead of time. Several of them nearly went bankrupt waiting for a crash they knew was coming, because the bubble kept inflating for months past the point where the underlying math had already broken. Being correct and being early are not the same thing, and history is full of investors who were right about everything except when. This is worth remembering the next time you see confident predictions about exactly when the next bubble will burst. The direction of a prediction and the timing of a prediction are two completely different skills, and almost nobody, in 400 years of financial history, has consistently mastered both at once. What history actually teaches you to watch for. If there's a genuine, practical lesson buried in 4 centuries of bubbles, it isn't, "Don't invest," or "Don't take risks." It's narrower and more useful than that. First, watch for leverage. Every catastrophic bubble in this video, 1929, 2008, became a catastrophe specifically because people were using borrowed money, not just their own. A bubble built on cash you already own can hurt you. A bubble built on borrowed money can ruin you, and often ruins the people around you too. Second, watch for complexity that nobody can explain simply. If the story behind an asset requires 10 steps of trust and nobody in the chain fully understands what's underneath, that opacity is not a sign of sophistication. History suggests it's usually a warning sign wearing a sophistication costume. Third, watch for institutional endorsement replacing independent judgment. When a government, a bank, or a trusted brand puts its name behind an asset, that's exactly the moment history says to ask more questions, not fewer, because South Sea and 2008 both show that institutions can be just as captured by a story as individuals are. And finally, remember the actual mechanics of who profits. In every single bubble covered here, the money didn't vanish into thin air when the crash happened. It moved. It moved from the people who bought last to the people who sold first. Understanding that a bubble is a transfer, not a disappearance, changes how you think about your own timing. The uncomfortable closing truth. Here's the part that should stay with you after this video ends. Every one of these bubbles happened to educated, informed, intelligent societies. Isaac Newton wasn't a fool. Amsterdam's merchants weren't naive. The bankers of 2008 had access to more financial data than any humans in history. Intelligence didn't save any of them, because bubbles aren't a math problem. They're a psychology problem, And psychology is the one thing that hasn't upgraded at all in 400 years. The tulip becomes the stock. The stock becomes the mortgage. The mortgage becomes the token. The costume changes every time. The story underneath never does. History doesn't repeat, but if you don't understand it, it will cost you the same way it's cost every generation before you. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.